after. As we've been reporting, oil is up today after Goldman Sachs set an $85 a barrel price target for the year. Now, our next guest isn't as bullish. While oil trades at around $69 today, he expects it to settle back down in the $50 to $65 a barrel range. Antoine Halff is the deputy head of research for Newedge USA, and he has worked as a senior analyst with the International Energy Agency. Antoine, good to have you with us.
Thank you.
So your estimate, 50 to 65 is the range. It's definitely below both Goldman Sachs, their call, which is a call that's definitely impacting the market. It's also what OPEC is calling for. They're looking for Mr. El-Badri talking about 70,
right.
75 a barrel. How come you're down?
Well, I'm just looking at the fundamentals of the market, you know, and the fundamentals are not the only driver of prices, but I think demand growth is a lot slower. Demand actually is contracting this year quite steeply, but looking forward, I think growth is not likely to resume at the kind of pace that we've seen in recent years.
Well, and kind of Mr. Bernanke kind of reinforced that with us, certainly talking about the U.S. market, that
right.
while things might not be getting worse, it's not going to get an awful lot better very quickly. So it's good to remember the fundamentals. You have to, right?
I think so.
Well, it's interesting because, you know, I have a viewer emailing in. This is Dean, and he's talking about, you know, a debate between those who say, well, there's a lot of speculation going on again, versus those who say, look at the fundamentals. You agree that there's a little battle going on here again?
Well, you know, first of all, it's not so easy to define fundamentals because sometimes we define it too narrowly. But I think the argument of people who said the fundamentals are bullish is based on a vision of the economy turning the corner, and then demand coming back with a vengeance, and supply being in short supply of oil because of a lack of investment, because currently prices being low, there's reports of many projects being delayed, postponed, and so on. And you know, I don't think that view is actually reasonable, because in my view, demand is not likely to come back in the same way. I think the experience of the recession and the run-up in prices last year is a game changer that will lead to a slower pace of demand growth in the future.
And supply. I mean, everybody keeps reminding, when I talk to any of the NYMEX traders, they say, don't forget, there's still a ton of supply out there.
There's a lot of supply, and just because oil prices have come down doesn't mean that project economics went down the drain. On the contrary, in some cases, costs have come down more steeply even than prices.
But if you're a long-term investor, fundamentally, doesn't it make sense that oil's going to trend higher down the road?
Yeah, well, you know, eventually we'll move out of the hydrocarbon economy, but in the midterm, I think, yes.
It's going to take some time. That's okay.
We're likely to see...
don't worry about that. You know, but it'll take some time, right?
In my view, it's going to take some time, yes. That being said, there is some upside risk to prices in the short term, not from the fundamentals of the market, not from the economy, but from the geopolitical risk, particularly the Iranian nuclear dispute, I think, could come back on the front burner as a source of
and we can't forget
risk
that.
premium.
We can't forget that. There is still a lot of geopolitical risk when it comes to the energy trade, the oil trade specifically. So last summer, $140 a barrel. We saw the oil. It obviously played out in gas prices for all those consumers. You don't see a repeat of that this summer?
No. In some ways, the run-up in prices of the last few months looks alike, like the one we had in the first half of last year. But the fundamentals of the market are so different that I think it's very hard to compare. We have now oil stocks in the U.S. at 11-year highs.
Got it.
We have demand at a 10-year low for the last week. So I think it's a very different market, and the outlook, in my view, is very changed. We're likely to see producers being much more inviting to foreign investment, much less nationalistic in their management of supplies, and we're likely to see demand growth much slower and a much bigger emphasis on fuel economy and conservation.
All right, we're going to leave it on that note, but obviously an interesting and fascinating market to continue watching. Lots at play. Antoine, thank you so much.
You're welcome.
Antoine Halff of Newedge.